In this Money Talk video, I'm going to discuss individual retirement accounts or IRAs, and we're starting right now. Hey guys, welcome to another video from the Keystone Financial Academy. My name is Elliot, and if you're new to this channel, I invite you to join the community by subscribing and turning on notifications so you don't miss any of the upcoming videos. So chances are you may have heard of an individual retirement account or an IRA, but you may not know all the details. If that's the case, this video is for you. An IRA is a retirement plan which allows contributions from workers outside of their employer. Now, employers can certainly set up IRAs for their employees, just as they do with 401k plans, but 401k plans are tied to employment. You can't set one up on your own. The IRA is the only Main Street retirement account that individuals can set up, fund, and manage completely on their own while still retaining all the tax advantages. IRAs were created in 1974 as part of what was called IRA legislation, and the two main types of IRAs are the Traditional IRA and the Roth IRA. A handful of other variants do exist, and they include the SEP IRA, the Simple IRA, Spousal IRA, Nondeductible IRA, Rollover or Conduit IRA, Payroll Deduction IRA, and the Self-Directed IRA. In this Money Talk video, I'll only cover the two main ones, Traditional and Roth, and leave the rest for another video. The Traditional IRA is the original and most common type of IRA, and it's fairly straightforward in how it works. You open an account and direct a portion of your pre-tax income toward investments such as stocks and mutual funds that grow tax-deferred. The advantage for the present time is a lower tax rate because you're using pre-tax income to contribute to your IRA and thus lower your overall taxable earnings. In most cases, contributions to traditional IRAs are also tax deductible. Now, the advantage down the road is that the capital gains and dividends earned by the IRA are not taxed until withdrawal, and then they're taxed at the regular income rate of whatever tax bracket you're in at the time. If it is presumed you'll be in a lower tax bracket upon retirement, you will then likely save money on taxes. Because the IRA has such tax advantages, the Internal Revenue Service limits how much you can contribute to an IRA annually. This is mainly so individuals don't use these accounts as limitless tax shelters. The 2020 limits were $6,000 if you're under the age of 50 and $7,000 if you're over the age of 50. Also, as of 2019, there's no upper age limit as far as contributing to your IRA, so you can continue to contribute to it for as long as you want to if you don't wish to retire early. No gross income limits exist to open an IRA, but there are income limits if you want to get a full tax deduction. This is on purpose so the IRA can provide the most benefit to lower and middle income individuals. What are the income limits to claim a full deduction? Well, for 2019, your modified adjusted gross income, or MAGI, had to be under $64,000 annually if you're filing single and under $103,000 if married filing jointly, with a sliding scale phasing out the deductions as you make more and more money. Now, pulling money out of an IRA is also a fairly straightforward process. You can begin at age 59 and a half, and there is a 10% penalty if you do it before that age. However, there are allowances for hardships and various life events. In general, a traditional IRA works best for workers who think they will be in a lower tax bracket upon retirement. And it's also for those that don't have access to other traditional retirement plans such as the 401k. However, it's also common to have both accounts. Traditional IRAs are quite popular in the United States, with about 33 million households holding at least one such account, for a national total of $7.5 trillion in IRA assets. To open a traditional IRA, or really any IRA account, you can go to a traditional bank or to an online brokerage such as TD Ameritrade, Vanguard, Fidelity, Merrill Lynch, Ally, Charles Schwab, and many others. Okay, so now let's briefly turn our attention to the Roth IRA. It is similar to a traditional IRA, but with a complete opposite approach to taxation. Instead of using pre-tax dollars, an individual pays taxes at their current rate upon depositing funds into the Roth. But then the funds grow and can be withdrawn completely tax-free. Essentially, individuals are being taxed on the smaller seed, not the larger tree years later, as is done with the traditional IRA and the 401k. If this sounds like a significant tax break, that's because it certainly is. The Roth IRA was originally called an IRA Plus and was introduced by Senators Bob Packwood and William Roth in 1989. However, all things in government take time, and it wasn't until 1997 when this type of IRA was actually established through the Taxpayer Relief Act and named after Roth, its chief sponsor at that point. Taxation aside, a lot of the other features of the Roth IRA are similar to the traditional IRA. For example, the contribution limits remain the same. It's still $6,000 annually if you're under the age of 50 and $7,000 if you're over the age of 50. Some income limits do exist to contribute to a Roth IRA, but they are fairly generous. For single fathers, your income has to be under $122,000 annually in order to qualify for full contribution, and this rises to $189,000 annually if you're married filing jointly. Withdrawals from the Roth fall into two categories: qualified and non-qualified. Qualified distributions is essentially money that you've put into the Roth, and you can actually withdraw that at any time. However, with account earnings such as dividends, capital gains, and interest, it's a different story. The main hurdle here is the 5-year rule, which states you must wait 5 years after opening a Roth IRA in order to access the earnings. And you must also meet several stipulated conditions, such as turning 59 and a half, or having a qualified life event such as using the funds for a home down payment. Whether or not a Roth IRA is better than a traditional IRA really depends on several factors. One of the factors is the tax bracket of the filer, another is the expected tax rate at retirement, and finally there's personal preference. A Roth is better if the account holder anticipates being in a higher tax bracket upon retirement, not a lower one. And taking advantage of tax-free withdrawals makes sense in this case. A Roth is also a better choice than a traditional IRA if you anticipate needing access to the money before retirement, as Roth withdrawal rules are a lot more lenient. Keep in mind, it's not unusual to maintain both types of IRA accounts, a traditional or a Roth, or combine a 401k with a Roth, which is exactly how I do it. Okay, so that was a quick Money Talk primer on the fundamentals of the traditional IRA and the Roth IRA. Thanks for watching, and if you liked this video and found it useful, please consider subscribing, and I will see you all soon.